We'll just wait a couple of minutes to allow some late people to arrive, and then we'll kick off shortly. Okay, well, it gives me great pleasure to welcome you to the 99th International Macro History Online Seminar. I'm Catherine Schenk, Professor of Economic and Social History at the University of Oxford, visiting the University of Bonn just at the moment. And it gives me great pleasure also to introduce Francesco Molteni, who was a postdoc at the UI and is now a fellow at the Rimini Center for Economic Analysis. He's coming on the job market, so it's really exciting to hear his very fresh work on international banking flows and financial crises. A little bit of housekeeping. Francesco is going to speak for about 40 minutes, and then we'll take questions afterwards. If you have questions, please put them in the Q&A box, which you can access through the bottom of your screen, and then we'll go through them. If you have a absolutely urgent question of clarification, please preface that with a hashtag clarification notification. I'll be monitoring that through the seminar. But because of the technical difficulties, we're hoping really that those will be kept to a minimum, and we can come back to most things in the last 20 minutes. As always, we'll be hanging on for another 15 minutes for informal chat as well after we get to the top of the hour. So you're welcome to join us in informal discussion. Okay, and with that, I think I'll hand over to Francesco to begin his paper.
First of all, let me thank the organizers for the opportunity to present my research in this series of international macroeconomic history. I should start with a caveat or a disclaimer that I am a macroeconomist. I'm not a macroeconomic historian. However, I think there are two good reasons to present my research here. The first one is the topic, financial crisis, which I think deserve knowledge of the past, also to better understand the recent episodes of financial crisis. The second reason is interdisciplinarity, and I spent some years at European University Institutes taking part of several interdisciplinary working groups, and in one of them I had an interesting discussion with a professor of history regarding the different views and approaches between economists and historians. And this, I think, is well summarized in this sentence of Charles Kindleberger, who is one of the most expert in historical financial crisis, which is also quoted in Kaminsky and Reinhardt, 1999, which is a seminal paper about the twin crisis, which is the simultaneous combination of banking crisis and the currency crisis, which is also the object of this paper. And I think this is a sentence is important to understand the reasons of financial crisis, because there are some causes which are recurrent over time. This is also called the usual suspect, or in terms of empirical literature, early warning indicators. For instance, recently there is attention towards the credit boom, the rise in bank lending to explain systemic banking crisis. But each crisis has also its own specific characteristics and peculiarities, often related to financial innovations. And for instance, there is a paper by Krishnamurti, 2010, who argues that financial innovations that were supposed to make the financial system more resilient, for instance, because of a better risk sharing, during financial turmoil turn out to be a source of amplification of the crisis, because economic agents would not well understand the functioning of those financial innovations. And Gorton and Thalman wrote a book in 2021 about different episodes of bank runs in the history, and they point to the short-run liabilities of banks as a source of financial instability. In particular, in the 19th centuries, there were demand deposits, and more recently, it was the wholesale market. This is also called the runnable liabilities, in particular, the repo market for the global financial crisis in 2007, 2008. And I have a paper regarding the role of the repo market for the Eurozone financial crisis in 2010 and 2012. And after the major episodes of financial crisis, there is also the tentative to figure out how the next financial crisis will look like. So for instance, Krugman 2001, after the East Asian crisis, wrote a paper, Crisis, the Next Generation, because there are different classes of currency crisis classified in generation crisis model. And recently there has been an interesting conference of the European Central Bank about the next financial crisis. And there is a debate about what is the source of financial instability that can pave the way of a future crisis like artificial intelligence, cryptocurrencies, silent bank run, transition risk related to the energy transition, and so on. So there is also a forward-looking aspect of financial crisis. Here I take my perspective as economist and I go through different episodes of twin crises and I look for a common thread. And in particular, I emphasize the role of bank leverage and a feedback mechanism between bank inflows, leverage, and exchange rates that characterize twin crises and differentiate those crises from other type of financial crises. So the outline of the presentation is divided into parts. I have an empirical part in which I present the data, and in particular, I construct a new indicator of sectoral gross inflows and outflows, in particular bank inflows with the stock flow decomposition. And I study the evolution and the dynamics of different types of capital flows around different types of financial crises. And I also try to make a link with the past episode of financial crisis in the interwar periods. In the second part, I rationalize the empirical findings with a model of financial intermediaries in open economy in order to study what are the factors that can make a twin crisis more likely and to what extent the macroprudential policy can reduce the probability of this crisis. And finally, I test the predictions of the model empirically with a discrete model of early warning indicator, and I find the theoretical predictions are confirmed empirically by the model. So this paper is related to several strands of the literature. There are some papers about the evolution of gross capital flows, also during periods of financial crisis. There's a huge literature about sudden stops, which are identified with contraction of net capital flows or current account, which can be due to a contraction of inflows or an increase in the outflows. Here I'm going to focus in capital inflows. So it is also related to the literature early warning indicators to predict financial crisis and the issue of original sin and the tendency of emerging market economies to issue liabilities in foreign currency, mainly US dollar. It's also related to theoretical papers about the links of banking and currency crisis. I propose a new explanation and related to self-fulfilling crisis and international bank runs. Also to the third generation crisis model of currency crisis in the wake of the East Asian crisis, in particular for the balance sheet mechanisms. And more recently, a recent trend regarding the role of financial frictions of banks in open economy to explain exchange rate fluctuation and deviation from the uncovered interest rate parity. So let me remind you some basic concepts in international capital flows. Capital outflows are the external liabilities vis-a-vis non-resident, the external assets, sorry, vis-a-vis non-resident, and the capital inflows are the external liabilities issued to non-residents. And the difference between the capital outflows and the capital inflows are the net capital flows. And recently, there is a shift in the focus between net and the gross flows because since often outflows and inflows are correlated, the capital inflows, net capital inflows is small, even though the gross outflows are sizable, and this can have implications for the financial stability, in particular when they are denominated in different currency. The standard classification of gross inflows and outflows is by asset class or instrument, direct investment, portfolio investment equity, portfolio investment debt, and other investment. But the balance of payments of the international financial statistics also provide a breakdown by sectors, in particular banks, corporations, government, and central banks for portfolio equity, portfolio investment debt, other investments, but not for direct investment. So I construct the indicator of bank inflows that the sum of the liabilities of portfolio investment equity plus portfolio investment debt plus other investment issued by domestic banks to non-residents. And symmetrically, I construct the back outflows as the assets of portfolio investment equity, portfolio investment debt, and other investment of banks, and similarly the other sectoral inflows and the outflows. It is possible also to relate the capital flows to the stocks because the international financial statistics provide data of the international investment position, and there is a direct correspondence between flows and the stocks. This is the stock flow decomposition identity. So the positions at the end of the periods, the stocks, is equal the transactions or flows plus the valuation effects, which can be due to change the exchange rate or change in asset price, and a small and negligible component of other changes in volumes, plus the positions at the beginning of each period. So the variation of the stock, the delta, is approximately equal the flows, the transaction, plus the valuation effect, which can be sizable, in particular for advanced economies. Now, even though the international investment position does not provide a breakdown by currency for the sectoral stocks, we can combine this information with the data set of the World Bank, the quarterly external debt statistics, which provide the composition for gross external debt position of banks with a currency breakdown. And in particular, this data set also provides the information on all the items of the stock flow decomposition, but only for these 4 countries, Belarus, Georgia, Romania, and Ukraine. So we can check whether the data of the IMF, the balance of payment, and the data of the World Bank match. And you can see that the match is very good for this series. Then we can also check the stocks with the external debt of the banks. You can see here the 2 databases. So the solid line is international investment position. The dashed line is the data of the World Bank. They are strongly correlated, even though there are some discrepancies. Here, I think an interesting stylized fact is that for these peripheral countries of the euro area, we observe a contraction in the external liability of the banks during the global financial crisis. Let me show you the summary statistics for the different types of capital inflows by instrument on the top panel and by sector on the bottom panel. You can see that bank inflows are the biggest and most volatile sectoral inflows, and bank inflows are also more volatile than bank outflows, and you observe a certain heterogeneity in the correlation between bank inflows and bank outflows across countries. Now, the sample of the analysis is composed by countries for which data on capital inflows is available between 1990 and 2019. Financial crises are classified with the classification of Leven and Valencia 2013, then updated in 2020 into banking crises, which are characterized by banking distress, like bank runs or rising non-performing loans, with the government intervention, like capital injection or rescue plans. Currency crises are periods of sharp nominal devaluation or depreciation of the currency, typically above a threshold of 30%, and this is the methodology proposed by Frankel and Rose in 1996. And sovereign debt crises are sovereign default to private creditors and debt reschedules. I also compare the chronology of the banking crisis of Leven and Valencia with other data sets of banking crisis. And you can see that there is a recent research, this is quite active areas of research to construct different dates for different types of banking crisis and bank runs. The twin crisis, I define the twin crisis as a combination of banking crisis and the currency crisis, similar to Kaminsky and Reinhardt 1999. They become more intertwined after the financial liberalization of the 1980s. And so I update the sample of Kaminsky and Reinhardt with the recent episodes taken from Leven and Valencia 2020. And we can distinguish 2 different periods of twin crises, what I call the slow crisis between the 1980s, the crisis in the South America, the Southern Cone crisis, and the early 90s, the crisis in the Scandinavian crisis, with the following crises, which are tend to occur in a shortened spell of time. And twin crises are important because they are very harmful in terms of GDP losses, and they're also characterized by slow recovery. There are different nexus of causality between banking crisis and currency crisis. One goes from currency crash to banking distress. This is because of the balance sheet effects of currency depreciation, in particular when banks are characterized by currency mismatch. And the fixed exchange rate regime, when a country tries to defend the currency from a speculative attack, the rise in interest rate can also be harmful for the banking sector. The nexus of causality can go also in the opposite direction. So from banking distress to currency crisis, when there is a collapse in the banking sector triggers a speculative attack, or because the bailout of the banking sector leads to the depletion of international reserves or expansion of government liabilities and monetary base. There are also explanations for the simultaneity or banking distress and currency crash, either because of common causes like recession, and this is the explanation of Levin and Valencia, of Kaminsky and Reinhardt, or because double drain, which is the domestic depositors withdraw their deposits because they fear of a future currency depreciation and invest abroad with a capital flight. Here in this table, I report the episodes of twin crises. So you can see in the first column, there is the period of banking crisis. In the second column, the date of currency crisis is also used to pinpoint the year of twin crisis. The left-hand panel report the values of the inflows by instrument, and the right-hand panel, the values of inflows by sectors. You can see that in the red values are the negative values for the bank inflows. And you can see that most of the episodes of twin crisis, 77% of twin crisis are characterized by a contraction in bank inflows. It's also interesting to note that in the aftermath of the global financial crisis, the only twin crisis is the crisis in Ukraine 2014. Similarly, for banking crisis, we have 30 episodes, but only 30% of banking stop. So this is another difference between banking crisis, so pure banking crisis without currency crisis. And you can see that after the global financial crisis, we have only 2 episodes of banking crisis, Guinea-Bissau in 2014 and Moldova in 2014. Then the dates of the pure currency crisis, so currency crisis without banking crisis. This is the most frequent episode of financial crisis, and 47% of currency crises are characterized by episodes of contraction in banking inflows. And finally, the sovereign debt crisis with 7 episodes. So this is the most rare episode type of financial crisis with 43% of bank stock. Next, I'm going to show the evolution of different types of bank inflows. So I take the average across the same types of financial crisis divided by GDP in a window of time between 2 years before the crisis and 2 years after the crisis. So on the left-hand panel, you can see the evolution of the indicator of bank inflows by instrument, so the standard indicators. You can see that nothing bad happens. So they always have a positive values. But when you look at the right-hand panel, so the inflows by sectors, we observe a sharp contraction of bank inflows in the year of twin crisis, almost 4% of GDP. And also we observe a mild contraction in corporate inflows. It's important to notice that other investment, which in the empirical literature is often considered as a proxy for banking inflows, behave very differently from the new indicator of bank inflows. So this approximation is not very accurate. And decomposing bank inflows by instrument, we can see that most of the variation is driven by other investments, typically bank deposit and wholesale funding. Comparing the other episode of financial crisis, pure banking crisis, pure currency crisis, and pure sovereign and the sovereign crisis, we do not observe a similar pattern in the contraction of bank inflows. So the bottom line here is that twin crises are characterized by a sharp contraction in bank inflows, which is not observed for other types of capital inflows and is not observed for other type of financial crisis. I'm going to then show some regression analysis and an exercise similar to Bronner and co-author 2013 in JME, in which I regress each individual capital inflows by instrument and by sector on a set of time dummy variables for the 5 years window around financial crisis. So you can see that for banking crisis, the time dummies are not significant, the same for currency crisis, while when we look at the twin crisis, we can see there is a negative and significant coefficient for bank inflows, and a negative and significant coefficient for corporate inflows, even though the magnitude is much smaller. It's also interesting to know that during sovereign debt crisis, we have a positive and big coefficient for the other investment, while we have a negative but not significant coefficient for bank inflows. Then I'm going to do the same exercise for different types of capital outflows during twin crisis. And you can see that the year of the crisis, we have a negative and significant coefficient for the bank inflows and a positive and significant coefficient for corporate inflows. So this means that the explanation of twin crisis as a double drain, so the simultaneous withdrawal of bank inflows that is invested abroad, is not consistent with our empirical result, and we are going to provide a different explanation of twin crisis based on the contraction of bank inflows. And the next table, I'm going to show the results for different group of countries. So you can see that the coefficient of the dummy variable is bigger for high-income countries compared to middle-income countries and low-income countries. And this is not surprising because the high-income countries have relatively bigger banking sectors, for instance, in terms of credit to the GDP compared to middle-income countries and low-income countries. While an interesting finding is that the coefficient of the dummy variable is bigger for the subsample after 2000 compared to the subsample before 2000. Next, I'm going to show some stylized facts concerning the stocks, so the external debt of banks during twin crisis. So you can see here there is a super boom bust dynamics in the external liabilities of the banks around financial crisis, so they increase and then they drop substantially. And it's interesting to note that these are denominated in US dollar. So the currency depreciation of twin crisis should increase the debt burden. However, as you have seen in the previous slide, the sharp contraction in the capital inflows can explain the reduction of the external liabilities of the banks around periods of twin crisis. I tried to make a connection with the historical episode of twin crisis, and this is a figure taken from Bordo and co-author in Economic Policy 2001. And they construct a new database for different types of financial crisis. And you can see that the twin crisis is not a novelty of the post-Bretton Woods periods, the financial innovations, but it is also present in the Golden Age period before the First World War, and in particular in the interwar period. So there are a series of papers by Bordo, Green, and Meissner that draw a parallel between financial crisis in the Golden Age period and the post-Bretton Woods periods. Here I try to make a connection with the financial crisis in the interwar period. So there are several European countries that experienced twin crisis in the 20s, Denmark, Netherlands, and Sweden, and also in the 30s, Austria, Germany, and Hungary. However, the mechanisms between these periods are different. So debt deflation in Nordic countries in the 20s triggered banking crises that were followed by currency devaluations. and this intensified the bank runs, with 129 bank failures between 1922 and 1928. While the case of Germany looks like instead some episode of financial crisis in emerging market economies in the 90s, because they are characterized by a boom-bust dynamics of international capital flows, with capital bonanzas between 1924 and 1928, followed by a sudden stop between 1928 and 1930. And this was also coupled with some fragilities in the banking sector of Germany, in particular, the role of short-term debt of banks issued to non-residents, to foreigners, but also the low levels of bank capital that was eroded by the hyperinflation in the 20s. And these are two elements that I study also in the theoretical model of twin crisis. So looking at the data, we can see that the creditor countries were mainly United States and United Kingdom. The debtor countries is mainly Germany. And so between 24 and 28, there was a rise in the capital towards Germany, also because of the different interest rate between the US and Germany, where the interest rates were higher. So it was capital inflows for speculative reason, like carry trade. And when the US monetary policy started to tighten in 28, we observe a reversal of capital. So the capital flew back from Germany to United States and United Kingdom. And this contraction in bank inflows is often indicated as one of the causes for the banking crisis in Germany in 1931, which spill over also to other countries like Austria and Hungary. I would like also to make a parallel between the financial centers nowadays and in the interwar. So there is a paper by Maggiori in American Economic Review 2017 that argues that the US basically act as a bank. So it borrow for safe debt securities, international markets, and lend abroad in forms of risky asset, equity, and FDI. And this is not very dissimilar to what did Britain and the United States in the interwar, that converted the short-term deposits into long-term lending. So there is this idea that financial centers operate like banks in international capital market. Now I'm going to explain the mechanism that I study in the model, first in words and then with a question. I propose a self-reinforcing mechanism between bank inflows, bank leverage, and exchange rate to explain twin crisis. So banks borrow from abroad in foreign currency, in US dollar, and they use this funding in order to provide loans to domestic firms in domestic currency, say pesos. And since bank inflows are sizable, this currency transformation exerts a positive effect on the currency. So there is a currency appreciation, and this increases the leverage of the bank through bank balance sheet effects. It's important to note that as long as the bank inflows increase over time, the banks don't need to convert the earnings in pesos into dollars to repay the debt, because they can repay the debt with the new funding that they receive in a sort of Ponzi scheme. And so this can create a boom dynamics. However, if for any reason the bank inflows they start to reduce, then the bank need to convert the pesos into dollars in order to repay the debt, and the opposite mechanism is in place. So there is a currency depreciation and a contraction of bank leverage, and this opens the door to the possibility of coordination failure and self-fulfilling crisis. Because if an investor believes that the other investors are not going to roll over the debt, is going to do the same, because it anticipates that in case of a contraction of bank inflows, the nominal exchange rate is going to depreciate, and this can cause a failure of the banking sector. And this created this vicious cycle of twin crises. So I propose a model in which the banker can borrow from abroad in form of foreign deposits, or from the household with domestic deposits. These are one period bond denominated in domestic currency or in foreign currency. And the capital is in fixed supply, so it can be held either by the banker or by the households. So the household can hold the direct capital, but they are less efficient than the banker in dealing with investment. And this explains also the presence of the bank in this economy. So the household maximize the utility function subject to the flow fund constraints. They consume, they can invest in deposits or in direct investment, in that direct capital, but they need to pay a managerial cost, F, which is a function of the capital holding. And the revenues of the households are the returns of deposits and the return of direct capital. So the first order condition with respect to deposit and direct capital provides the Euler equation, and it's interesting to note that the managerial cost reduce the returns of the capital held by the household. So the higher is the stock of the capital, the lower is the return of the capital held by the households. The bankers consume only when they exit from the market. So during their lifetime, they accumulate retained earnings, and each period they exit with probability 1 minus sigma, and they survive with probability sigma. So the function, the objective function of the bankers is to maximize the present discount value of the future earnings when they exit. They exit with probability sigma I minus 1 times 1 minus sigma. And they invest in the new capital using the net worth and the deposit, domestic deposit issued to the households, and the foreign deposit issued to non-residents, to foreign investors. And ST is a nominal exchange rate, and the currency depreciation is equivalent to a rise in S. The evolution of the net worth is this equation saying that the returns of the asset minus the repayment of the deposit in domestic currency and the deposit in foreign currency. The bank faces the following incentive compatibility constraint, which is standard in the model of banking of Gertler and Kiyotaki. And basically, the bank can divert, after having received the funding, a fraction theta of the asset for personal consumption. But in this case, the banking is going to default, and the lender are going to recover only a fraction 1 minus theta of the assets. And so since they are aware about this possibility, they're going to lend only if the franchise value, VT, of the bank, so the value of operating honestly, is bigger than the value of the asset abscond. And theta, the fraction of the asset that can be abscond, is a function of XC, and XC is a share of total asset financed with the foreign liability. So it's a sort of currency mismatch or liability, dollar liability of the banks. And also you can see that the returns of the bank asset are higher of the return of the capital held by the household because the banks do not have managerial costs. We can rewrite the problem of the bankers in terms of XC and in terms of the leverage, which is the ratio of total asset over equity. And we can rewrite the incentive compatibility constraint in terms of mu t, which is the excess return of asset over deposit, mu t star, which is the cost advantage of issuing the foreign deposits compared to domestic deposits, which you can see is a function of the YP premium, and the marginal cost of deposit. Y omega t plus 1 is the stochastic discount factor of the bankers, which is a weighted probability of exiting and staying.
10 minutes now, Francesco.
Yes. If mu t and mu start are positive, the incentive compatibility constraint binds, and combining the first order condition with respect to the leverage and with respect to the currency mismatch, we obtain these two expressions of XT and VT. And intuitively, this equation says that if the YP premium widens, the banks has an incentive to issue liabilities in foreign currency rather than in domestic currency. However, in this case, there is a trade-off, because if the foreign liabilities increases, then also theta increase, and this reduce the leverage of the bank and also the portfolio of the bank. So here is interesting to know that in the standard models of YP premium, there is an arbitrage. So the investors decide whether to hold assets denominated in domestic currency or assets denominated in foreign currency. In this model, instead, the banks decide whether to issue foreign liabilities in foreign currency or to issue liabilities in domestic currency. So here, the YP premium determine not the portfolio of the agent, but the liability structure of the bank. So the international finance are basically, they maximize their utility subject to a flow fund constraint. They receive exogenous endowment, and they consume and they invest in the foreign deposit. And now we can study the problem of the case of twin crisis, which is a region where the economy enters in a crisis zone. And this happens when the outstanding liabilities becomes bigger than the value of the assets. So in this case, this variable ZD is smaller than 1, which means the net worth of the banks becomes negative. And here we can see the role of the exchange rate. So if there is a currency depreciation, so ST increases, the liabilities of the bank increases, and the foreign investor, they stop to roll over the debt because they anticipated, in this case, the banks is becoming insolvent, and so there is this self-fulfilling prophecy. And we can rewrite this equation in this way. We can rearrange, and we can see that the probability of the crisis depends on the returns on the asset of the bank, on the leverage fee. It depends also on the spread between the interest rates of domestic deposits and the foreign deposits, or saying differently, a rise in the foreign deposit make more attractive the economy, so it reduces the probability of the crisis. And finally, the currency mismatch, the liability dollarization, has ambiguous effect on the probability of the crisis because it has a direct effect. Here you can see in the denominator. So a rise in the currency mismatch increases the denominator and makes the probability of crisis more likely. And this depends also on the spread between interest rates. But there is also an indirect effect because a rise in the currency mismatch reduce the leverage and so also reduce the probability of the crisis. So the crisis is a combination of two probabilities. One is the probabilities that the economy enters in the crisis zone, and the other probability is a sunspot. So this is a variable that can take the values 1 or 0. So if take the values 1, there is a crisis, and this is kind of expectational shock or a coordination failures. And you can see that also the returns on the asset then incorporate a risk premium, which depends on the probability of the crisis, but the return, the risk premium is the same for domestic and for foreign deposits. Now we are in a situation in which we can study the implications for financial regulation. So first of all, it is possible to reduce the probability of the crisis by setting a maximum leverage. So we need to impose that the banks cannot have a leverage higher than this threshold, which is equivalent to imposed capital requirements. Or alternatively, there are different measures that reduce the procyclicality of the leverage to exchange rate. And in particular, the leverage becomes less sensitive to fluctuation in the exchange rate, either with a reduction in the parameter B, which reduces the derivative of theta with respect to the currency mismatch, or through differentiated reserve requirement. And it's important to notice here that this type of financial regulation, instead of capital controls, can have a direct impact on the probability of a financial crisis. And then I study empirically the prediction of the model with a discrete choice model to estimate the probability of financial crisis with a multinomial logit model. So I construct the dependent variable as a window of twin crisis that takes value 0 during tranquil time, value 1 in the 3 year before the crisis, value 2 the year of the crisis, and the value 3 in the post-crisis period. And this empirical strategy is used in order to avoid what is called the post-crisis bias, so the fact that after the financial crisis, this can affect the predictability of the leading indicator. So I run this regression in which these variables is regressed on different types of inflows and outflows over GDP, and a set of controls which are standard in the literature of early warning indicators. So first I show you the result for each individual capital inflows, and you can see that bank inflows is the only inflows which has a significant coefficient, a negative coefficient, means that a contraction of bank inflows help predict the occurrence of financial crisis, while a rise in bank inflows in the run-up to the crisis can make the economy more prone to financial crisis. This result holds also when we control for these other early warning indicators, in particular output gap, reserve, current account balance, and real exchange rate. And interesting, I'm going to compare the prediction of this model with other set of indicators that I take directly from the model. In particular, I include the leverage, the return on asset, and the foreign liabilities.
Just
And you
very
can see that
quickly, I
not
think,
only,
Francesco, moving towards the last few minutes.
yes, yes. So you can see that not only they have negative and significant values, but also that the predictability of the model with these bank factors is higher than the predictability of the traditional indicator of bank flows. So to conclude, in this paper, I construct an indicator of sectoral gross border flows and banking flows. I found new empirical findings on the dynamics of capital flows around financial crisis, and I provide a new explanation for twin crises as a feedback loop between bank inflows, leverage, and exchange rate. And I also provide the new early warning indicators for twin crises. Let me conclude with some policy implications and further research. So we observe a few episodes of systemic banking crisis and twin crisis after the global financial crisis, even though the post-COVID crisis is a period of financial vulnerability because of the currency mismatch, the high volatility in capital flows, and also the tightening of US monetary policy, which is typically associated with episode of financial crisis. So here I propose as a possible explanation the introduction or the tightening of macroprudential policy that made the financial system more resilient, in particular capital requirement. And another question is, if macroprudential policy can reduce, is so effective to reduce the probability of the crisis, why macroprudential policy is lax before financial crisis? There are two possible sets of explanation. One is political economy, which means that the politicians are aware about the possibility of a financial crisis, but they don't want to reduce economic growth, credit, and so on. Another explanation instead is based on learning process. I call this time is different syndrome, in which policymakers learn about the past episode of financial crisis, but then they tend to forget the lesson that they learned. I'm stop here. Thank you very much.
Great. Thank you so much, Francesco. I'm sure there's plenty questions to come through, and we have a couple already. To give people a chance to type into the Q&A, maybe I could pull up a couple of things that occurred to me when I was reading the paper. I wondered a little bit about your measurement of flows as sort of essentially T minus 1, and about the frequency then of your data, and whether taking sort of 2 end years to generate your flows, there might be, if with higher frequency data, you're seeing that the surges and the declines are actually internal to your tenor. Is annual data enough to be understanding the impact of flows on financial crises? You're muted, Francesco. You can leave yourself unmuted.
So the length of the windows are kind of standard in this literature, 2 or 3 years before and after financial crisis. In a follow-up paper, I studied the impact of capital flows on the exchange rates, not only during financial crisis, but also during regular business cycle. And I use this uh, quarterly frequency, and I find that this what I call a revisited portfolio balance model can explain not only the in-sample, not only have good in-sample properties in explaining the exchange rate, but also have very good out-of-sample properties, and the model can beat the random walk. So this relationship between banking flows and exchange rate depreciation is also observed not only during a financial crisis, but also during regular business cycles.
Thank you. The BIS's locational banking statistics have counterparties on a quarterly basis that might be useful to you. Can I ask you to stop sharing your screen? We've had a request because nobody can see us. Great. Okay, and we had a question from Eugene White. First of all, he's kind of thinking that the Kindleberger quote should be taken with a grain of salt, I think, in the way that economists and historians think about things is a little bit probably on the extreme side there for simplification. But he's worried a little bit more about focusing on the flows, whether the policymaker can really anticipate a crisis. Given the kind of, I know that you've got sort of the years in the run up to the crisis and looking for early warning signals, but he kind of characterizes as the flows seem kind of passive. They're sort of sloshing around, and the markets change and respond to these changes as well. So can you speak a little bit more about the predictive abilities of your model to be helping with the macroprudential?
Sure. So just a comment on the data. So BIS locational data, because I also work with this data in the past, they are basically data on bank outflows. So basically, let's say, for instance, what is the external asset of the US vis-a-vis the rest of the world. So they measure different concepts. Concerning the leading indicators, basically there are two possible approaches. One is using this discrete model. I mentioned a couple of studies like Gurinchas and Dobsfeld in American Economic Journal 2012, also Currencies in Review of Economic Studies in 2015, which use this discrete model. The other methodologies instead is the signal, and this is also what is used by Kaminsky and Reinhardt. And then you can have two types of errors. You can have a false signal, which is the second type error. So we cannot track possibility of financial crisis, or instead we have the fact that there is a threshold, there is a signal, but it does not correspond to a financial crisis. This is the first type error. Concerning macroprudential policy, often there is a problem, what is called inaction bias. And this means that the financial regulators face a trade-off because if they tighten financial regulation in the short run, they can, for instance, reduce the economic growth because of a lower credit, but they can make the financial system more resilient. So sometimes there is this what is called in the literature inaction bias, which can be related to what I mentioned, the political aspect of macroprudential policy, and so whether it is better to allow for a higher rate of growth, but with the probability of a crisis, or instead it's better to lean against the wind and reduce, for instance, the credit, but at the same time, reducing the probability of financial crisis. Here, what I want to emphasize is that it's not the capital flows itself, which is a source of financial vulnerability, but this is mechanism with the balance sheet of the banks. So if, for instance, the banks are well capitalized. Then the high volume of bank inflows entering the banking system, if it does not produce like excess of credit boom, then it's not so harmful for the economy. And so it is important to distinguish between capital controls that reduce the volume of the bank inflows entering the economy and the macroprudential policy that instead reduce the probability, the financial vulnerability of the banking sector by limiting, for instance, the leverage or for instance, the vulnerability to bank runs.
Okay, thanks very much. I think I possibly asked Eugene's question not very well. He'd like to come in himself. Could he be unmuted? Are you willing to do that, Eugene?
Yes. Can you hear me?
Yes.
Okay, so
Yes.
well, just to amplify what Catherine said, is that what I was saying that the historian and the economist are really doing different things that are trade-offs, because the economist wants to give a well-defined, explain lots of events, lots of crises, and wants to use a parsimonious number of variables. But that, of course, leaves out possible common explanations because you don't have continuous variables which cover time and space. The historian, on the other hand, was willing to focus on one crisis and look at a great variety. And there's sort of trade-offs. Now, a question I have is really, and I think Catherine have sort of hit on part of this, because you said, for me, when someone says, well, this is the state of the literature, this is the data we use, I get kind of hives because she's right, is that you miss things. If you look at what annual data in stock market crashes, you miss 1929 for the most part. And it happens all the time. And in fact, bankers' decisions are made, they don't make decisions once a year. They're a much more higher frequency. And we can see that, I mean, if you think about what, January 2025 and 2024, they're very different worlds. And I think that you're getting a lot of, there's a lot of co-movement of a lot of variables. And I kind of worry that it doesn't really give policymakers much of an idea of what to look for. It doesn't take into characteristics of the market, which I think, and there's a longer comment you can see about what precipitates a movement in bank deposits. What's driving this? So they don't independently move. There's some events which are causing it to act. I'll shut up.
I was quite struck that Ukraine 2014, for example, comes up in your data. And of course, that's the invasion of Crimea is causing a crisis. And so the causation, I think, matters possibly. Go ahead, Francesco, you're still muted.
So, first of all, the initial quotation was useful to distinguish two classes of explanation. One which is recurrent to financial crisis. Another type of explanation which instead are crises, are the causes which are typical of each individual crisis. Concerning the question, I think this is a case in which I use the new data for all the question. So there was a debate, for instance, after the East Asian crisis, and there are some papers in which they point out the role of bank inflows, but they do not have the data, for instance, to test or the very limited data availability. So these new data sets of the IMF, these new indicators can address these questions. Then concerning possible economics, because like everything or almost everything is partly endogenous, but that's why I control for a bunch of indicators in order to disentangle or try to disentangle the different forces that can explain the occurrence of financial crisis. And I think this is kind of standard methodology in economics. So I rely on the existing methodology of financial crisis. And this is also the purpose of the model, right? The model help to disentangle the different forces, because with the model you can depict more clearly what are the mechanisms that explain why a certain variable can affect another variable, which sometimes is more arduous with the data.
Great. I think the next question from Stefano Battalosi follows up on this a little bit in terms of the models. He writes that the models of twin crises are built on an assumption of fixed exchange rates, but the number of countries with pegs declined dramatically after the Asian financial crisis, or the 1990s. Do you think this change requires a fundamental revision of how we should think about the connection between the exchange rate and banking stability?
So we don't observe in the data that twin crisis occurs more frequently with the fixed exchange rate regime or with a flexible exchange rate regime. So the occurrence of financial crisis, and they can occur with both the regime. This is what the data say. And the exchange rate regime have different implications for the mechanism. So with the fixed exchange rate regimes compared to the flexible exchange rate regime, and there are different links between currency crisis and twin crisis. My model is address more the case for the fully exchange rate regime. So for instance, I do not take into account the possibility that international reserves are used to defend the currency, or that address more the case for fully flexible exchange rate regime.
Thanks very much. I wondered how easy it is to distinguish the kinds of flows. So I can see that they're recorded differently by the IMF in your data, but they're probably interlinked bank, corporate, and sovereign flows. You may be counting the same thing in terms of, and there's also going to be hedging on the other side of some of these transactions. So do you feel confident in your identification of the different types of flows?
Oh, sorry, it was off. So this is a good question, because I computed the correlation between bank inflows and the bank outflows. I did not compute yet the correlations of different types of capital inflows, so this is something that I can do. I was also thinking about to compute, this is something which is done in the literature of the global financial cycle, the principal components of the different bank inflows across countries, because my prior is that they are highly synchronized. And so I think that, for instance, the first principal component can account for a large share of their variance. And this can also be an important channel for the international transmission of the US monetary policy. But this is something that it is in my to-do agenda.
Thanks. I guess I was thinking of the doom loop and other sorts of things where sovereign debt ends up on the balance sheets of banks, and just that the recording of these things in a complex globalized financial system is difficult to disentangle.
Can you please repeat? I did not understand.
I guess I was just thinking that I was very struck by your charts near the start showing the different patterns of behavior of corporate, bank, and other types of flows. And then I started to wonder how those are disentangled in practice, since presumably a lot of the bank flows might be related to corporate borrowing, might also be related to sovereign borrowing. So there's an overlap, not just a correlation.
So there are two possible explanations. One is the literature on the pull and push factors, right? So if you think that the pull factors are important causes of this type of inflows, they should have similar impact on, for instance, corporate flows and banking flows. But on the other hand, there is a literature, for instance, showing that macroprudential policy, which can be considered as a type of pull factor, can also explain a divergent behavior of corporate flows and banking flows. So, for instance, if you tighten the macroprudential regulation and banks can borrow less from abroad, typically you observe a rise in the corporate inflows. So there is possible spillover effects across different type of flows.
Thanks. We have one related question from Robert Farrago. You listed the ECB's potential triggers for the next crisis, including silent bank runs, which is a newer and faster phenomenon. And he notes that non-bank financials are now sizable. Do you think your model will need adjusting for the current financial landscape?
Definitely. So the model is about the past episodes of Twin Crisis. And so I show that banking, and in particular bank average, can be an important source of financial instability. And now there is a big debate about the non-bank financial institutions, and the volume is increasing over time. However, at the same time, there is also a debate whether to start to deregulate the financial regulation. And so my paper, my model says that this requires some caution to start to deregulate the financial institution, because the risk is that, as I said in the conclusion, we are going to forget the lesson that we learned from the crisis. At the same time, I have also the data for non-bank financial institutions. So this is something that I could study in the data, but the model does not take into account this, let's call it a shadow banking system.
Excellent. Thanks very much. I feel like we've come very quickly to the end of our allotted slot. We will be around for the next 15 minutes for any further questions. I wanted to herald, however, that, as I said, this is the 99th MacroHist seminar, and the next one will be the centennial edition, and it's going to be a doozy on the 22nd of October. It's going to be a panel on geoeconomics, which is extraordinarily topical and important issue at the moment, with Dale Copeland, Jesse Schrager, Chris Trebish, and Chris Michener on a panel discussing these really important issues in a historical context. So we look forward to seeing you then on the 22nd of October. So at that, I think we should all thank Francesco for the formal part of this event, and I'll release you back into your duties, except for those who'd like to stay on and have a quick chat. So thank you very much, Francesco.
Thank you for the questions and for attending the presentation.
Sorry, I'm falling apart here. Rui,
Yeah.
Nathan, do you want to come in?
Yeah, I can I can start coming in. Maybe take a glass of water. Oh, thank you for the presentation and very interesting paper. I want to, I mean, so there's this stylized facts about the original sin, which is kind of in the background of a lot of what you're doing here. And although the original sin literature originally relates to sovereign debt and sovereign borrowing more than to bank borrowing, but I think kind of the gist is in many ways similar. But is there a way to disentangle the two? Because especially for emerging economies, so let's take an example that the sovereign is borrowing in foreign exchange and is exposed to this original sin that, then and all the mechanism that we already know in the literature, and say the domestic banks just lend in domestic currency. They have no foreign exposure, but because of the crisis that is generated by the sovereign borrowing, then corporates cannot repay their debt. I mean, you got these, and the banks are faced with similar problems on their balance sheets in terms of their assets. So is there a way you can distinguish these things, and whether historically, so I'm trying to put us back a little bit into history, whether, if we go back in the past, it's more of the sovereign type of original sin, and nowadays it's more of the banking, and maybe in the future the non-banking financials will be the ones. But is there some kind of a change, or just give us some I like to hear your ideas about this.
So this is a very topical question, and even in the book of Sam Blanchard and Summer, Rethinking Macroeconomics, Evolution and Revolution, there is a section about international macroeconomics, and there is this debate whether the original sin is a problem for emerging market economies or not. And the question, as you say, depends on the composition in the sector. So, for instance, the sovereign liabilities of emerging market economies are becoming mostly denominated in domestic currency. So basically, let's say, to use an expression of Reinhard Rogoff, emerging market economies graduated from the original sin problem. However, if we look at the external liabilities of firms and banks, they are still denominated in foreign currency, mainly US dollar. There is a paper of Jewish Schrager that showed this stylized fact. And this phenomenon is also called the US dollar dominance. So concerning the external liabilities of firms and banks, they are still issuing liabilities in foreign currencies. There are a number of explanations for this, but in terms of stylized fact, this is what we observe also with the BIS data. And yes, in the past, I also read your paper with friend Rao concerning the original sin to the sovereign, and so there is some echoes between this recent literature and the literature of the past. And this also is also related with the issue of the effects of currency depreciation. And this is also, again, for emerging market economies, if there is some theories that suggest that exchange rate depreciation can stimulate economies because it increases the export and so on. However, for emerging market economies, where the balance sheets of the firms and the banks are denominated in US dollar for the liability side, this can instead create some adverse balance sheet effect. So this issue, this topic of original sin is still very relevant, even for the current debate.
Thank you.
I think Rui wanted to come in.
Yes, I did. Well, I agree with the way you agreed in answering Nathan's question. So I have related questions. So first one is, I have questions about the identification of the data which map to previous ones. What exactly are these flows measuring? And also I have questions about policy. So in terms of data, right? So even if you have more foreign borrowing, it can come in different currencies. I thought Nathan would ask you this one, but I guess you cannot distinguish by type of currency, right? So you just perhaps assuming dollar dominance and just assume this is a dollar and everything is driven. All the boats go up once the dollar goes up and all come down. All right. So and that's probably what you're going to tell me. But then there's also the question of the other side of the balance sheet, right? So you have banks that borrow more in foreign currencies. This generates a perverse feedback loop because more capital inflows lead to currency appreciation, which leads to even more capital flows, and then eventually this all blows up. But then what's happening with those flows? Where are they ending? Are they funding real estate companies and the real estate boom? Are they funding the government? And historically, having an historical perspective, you've seen different cases of all possibilities, right? I'll just give you an example, Brazil. In the post-war, there was a bank, or there's still a bank called Banco do Brasil, which by the name sounds like the central bank of the nation, but it's not. But effectively worked as a major intermediary for sovereign borrowing from abroad. Now, how do you classify this? Do you classify this as external debt and a problem of original sin? Do you classify this with excessive exposure of the bank to foreign capital without looking at what the bank was doing on the other side of the balance sheet? I think these things matter, right? If if you're really going to make a contribution to overall knowledge. But then there's also the question of monetary policy, which is really I don't know if it's passive or missing in your model. So just take exchange rate over valuation. We don't need to cast our memory to history, right? We know what's happening right now in Argentina. Okay, so there's over evaluation. There was a lot of capital inflows, but this was a conscious policy by the government to disinflate, right? But if you don't have some kind of Taylor rule or some monetary policy function in your model, it's a bit unclear, again, whether you're really identifying something or the story is a bit more complicated. So I'll leave it at that. Thank you.
So very interesting questions. Let me start with the data. So the data measure the external liabilities vis-a-vis non-residents, the international investment positions. So I don't have the currency composition, but I can rely on the data of the World Bank, which also measured external liabilities, and they're also divided, they also have the distinction by currency. So I can, foreign currency versus domestic currency. Then for the foreign currency, I don't have all the breakdown, for instance, whether it is US dollar, yen, Swiss, and franc, and so on. And this decomposition, I think there is a database of the BIS on the bilateral flows, which, however, is not publicly available. And there is a couple of papers in Journal of International Economics, but they cover a very short spell of time between, for instance, one is between 2012, 2018. So I think there is some room of improvements for the data on this direction. The other two questions are also very interesting concerning the asset side. So there are two different answers. The first one concerns the currency composition of the asset, because even if the banks lend to the domestic economies, let's say in a foreign currency, like in US dollar, then a currency depreciation can hurt the banking system because the currency mismatch passes from the banking sector to the firm sector. And so if the firms cannot repay the debt, the bank again is going to suffer losses. So the problem remains. The other way around, the other question also, there is a paper by Cesabianchi and co-author that shows that bank inflows, they tend also to have a positive effect on the housing price. So one of these effects of the bank inflows is they tend to increase, for instance, the demand for house, the collateral goes up, and this create a sort of a credit boom, if you want, in the economy. I'm working, or I wrote a follow-up research project in which I would like to measure the relationship between what I call bank bonanzas, and these are the large inflows into the banks with the credit booms. So there is a recent literature on the credit booms, bad booms versus good booms. So bad booms are the booms that end up in financial crisis. Good booms are the booms that do not end in financial crisis. And so I think it would be interesting to relate the study of bank inflows to this trend of the literature concerning a credit boom. This is in my research agenda. Then monetary policy, this is another good question. So the model can be incorporated in let's say, in a more complex DSG model. For the time being, I want to take as much as simple as I can, because I want to emphasize this new channel. And I want to say, look, these are mechanisms different from, for instance, the monetary policy mechanism. And there is a paper by Kalemlios Khan and Unsan, 2014, and they argue that the emerging market economies were insulated from the capital flow reversal associated to the hikes of the US monetary policy in 2022, 2023, because they had better monetary policy rules. They were more sticky to Taylor rules and so on. So this is a type of question that can be addressed by extending the model, introducing the monetary policy rules. But my impression is that then you have different channels at play. And for the time being, I would prefer to focus on this new mechanism. And then I can also introduce other elements in the model to study other effects that for the time being are not there.
Yeah, I guess.
Excellent.
Yeah, as a good economist, right? You try to slice a very complex problem in more manageable slices. Right,
But
back to
also
you,
looking
Catherine.
forward to future research agenda and stuff. So I hope that you found the comments useful, Francesco, as you're developing your work. I think we had 55, 60 participants at one point. So so that's a great audience for you. And I think we'll leave it there, shall we? It's nice to see you, Nathan.
Yeah.
Yep.
All right.
Great.
Thank you so much.
Okay, thanks so much, everybody.
Thanks, everybody.
Thank you for the questions, and I have a lot of thoughts for the next days. Thank you so much.
Okay, nice
Bye-bye.
to see you.
Keep well.
Bye.
Bye bye.
Bye-bye.